and welcome back to Never Change. Here I intend to go through my Qualcomm analysis. So what is Qualcomm? They are a multinational corporation headquartered in San Diego, California, incorporated in Delaware. It creates semiconductors, software and services related to wireless technologies, and critically for this analysis it holds critical patents for 5G, 4G, etc. Founded in 1985, employs approximately 41,000 employees, has an annual revenue of 23.5 billion. Current CEO is Steve Mollenkopf, since 2014, quite well respected in the industry, and is being replaced by Cristiano Amon in June 2021. Don't know this chap, but it was a unanimous board decision for him to be appointed as CEO, so must be good. And critically here, which I think will be good for the company, is they're replacing an engineer with an engineer. Biggest competitors, so concentrated here on the 5G space. So you've got Samsung in South Korea, Ericsson Sweden, Nokia Finland, and Huawei and ZTE Chinese companies. Credit rating, so let's go into the analysis. Credit rating, no concern here, considered low credit risk. Both Moody and S&P both consider it in the upper middle grade, both affirmed. Common size analysis, so this was not very easy to do because the revenue is quite choppy for the past 4 years. Very up and down, so I've gone with averages. So in regards to revenue, on average they're increasing at 5% per year. Not an astronomical percentage, but for the industry it's about average. Cost of goods and services is trending down slightly over 4 years, so getting more efficient with how they deliver their goods and services. The gross profit is also trending up slightly. Operating expenses are trending down, so growing revenue, because revenue growing up, cost of goods and services trending down, and operating expenses trending down. So good indicator. And another good point I'd like to indicate here is that their research and development, they've maintained about 25% per year, even with the bad 2018 result. They've still managed to maintain at 25% per year in R&D. One thing to highlight here though is if you do look at 2018, they had a $4.8 billion loss. So I've done a little bit of research into that, and it was a failed acquisition of a European company called, I believe it was NXP Semiconductors or something like that. There was also some European regulator issues as well. So moving on to earnings. So if we look at earnings, they've beat all of their 2020 analysis consensus on their EPS. And also, if you look at the financials, it shows profit trending in the right direction since 2018. So Moat Analysis, so EPS over a 4-year split is going on an average of 37%, so way above that 10% we're looking for. Operational cash flow per share is also up at 13% per year, so greater than that 10%. Revenue only trending up at 5%, so only increasing by 5% per year on average over 4 years, but for the industry that's about average. Book value per share is also increasing nicely at 37% on average per year. So return on equity, return on invested capital. Return on equity is skewed a little bit here because they've been aggressively buying back their shares, so it's inflated it to 86%. So if we move over to return on capital invested, that's running at 24%, so good indicator. And the debt to earnings ratio stands at just very marginally over 3 years, so no problems there. So margin of safety, so if we put Qualcomm's parameters, current parameters into the model. So EPS trailing over the last 12 months, it stands at $5.85. Earnings growth rate 20%, future PE multiplier 17.33, and a minimal acceptable return to us at 15%. Using those parameters gives a valuation of about $156 a share. So based on that, with a 25% margin of safety, you're looking at a share price of $117.25. Same parameters at a 50% margin of safety, you're looking at $78.17. I would say that it's probably very unlikely that this company will go down to $17 in the near future, just because of the prospects going forward. So let's look at the foundations. Let's do the 8-pillar analysis. So they passed 6 of their 8 pillars based on a share price of $139.13, which gives a market cap of $158 billion. PE ratio 23.99, so slightly above the 20 we're looking for. Profit margin greater than 10, they came in at 25.21, which is excellent and well above the market average. Revenue growth about market average 5% per year, but it is growth. Profit growth, yes, 20%. They are heavily buying back their shares, so shares are decreasing, and the liabilities are only 83% of their assets, which is quite high, but nothing really to worry about. Free cash flow, yes, is growing, but the price to free cash flow sits at 25.17, so slightly higher than we would want it. So if we run that back through again with a 25% margin of safety, so currently at $117.25, with the outstanding 1.1 billion shares, would give a market cap of 133 billion. The free cash flow last year was 6.291 billion. So this would give a PE ratio of 20 and a free cash flow of 21.24. So slightly so meets the PE ratio target we're looking for, and slightly above where we would want the price to free cash flow. So pros regarding continued growth. So Qualcomm is very well placed to capitalize on the 5G rollout. They already have over 120 5G license agreements, and hold some very valuable fundamental 5G innovations, which they've also patented and licensed. They've invested heavily in R&D over the past 15 years to the tune of 67 billion, which is then reflected in their portfolio of inventions that are patented, which to the tune of 140,000 across over 100 countries and jurisdictions. They're heavily investing in AI. They have a diversified portfolio of products, so they're not reliant on a single industry or sector, and the previous lawsuits with Apple have now been reached and settled. So I wanted to include this on 5G patents. So if you've seen my Ericsson video, link above, if you're interested, you'll see the breakdown of how many patents each company has either been granted or impending. But that only tells half the story, because what I would want to know is, out of all of those patents, which ones are system critical to a 5G infrastructure. So the bar chart above goes some way to doing that, but I will require a bit more research into this, because this was quite an old bar chart that I found, which applied weighting to the patents in regards to how critical they are to delivering a 5G network. And as you can see at the top, Qualcomm comes out it's very weighted in Qualcomm's favour. So we'll require a bit more research into those critical system 5G patents. Limiting factors. So I'm sure we're all aware there's currently a shortage of semiconductors. Qualcomm doesn't produce in-house. It uses SMIC, Samsung and TSMC. So reliant on their continued ability to grow as well as its own. So it's dependent on those companies. There is also a global shortage of silicon at the moment, which will start impacting. And moving into the 5G space, yes, there's going to be a huge in the next 10 years. The revenue being able to develop from 5G space will increase massively, but also China is very well positioned to capitalize on that, and not all governments are going to bar the use of Chinese technology in their country. So yeah, be interesting to see how that one pans out. So my conclusion is that, so no issues around credit rating. Common size analysis could be considered amber, but if you look at the averages, they all seem to be trending in the right direction. Moat analysis, no problem. Return of equity, return on invested capital, no problems there. Long-term debt could be paid off in a ratio of 3 years compared to net income, so no problems there. They passed 6 of their 8 pillars, so yeah, amber. So going forward, Qualcomm has good growth potential. It holds critical patents in a number of areas where there should be considerable growth in some of the 5G technology space. They have some risks that are manageable, but some risks that are not. And so the risks that are not are the ones where they're dependent on other people to grow. So the current share price at the time of filming this was $139.13. It's probably about right for where this company is at the moment. So if you wanted to apply, say, a 20 to 25% margin of safety, I'd wait for the share price to come down to around $117 to $120. I wouldn't try and apply a 50% margin of safety to this company, because the chances of it going down to $78 a share again is pretty slim to none. Yeah. So what do you think about the analysis? Do you think I've missed something? Have you reached a similar conclusion? Yeah, please let me know, and thank you for stopping by.